0.6% decline, so another disappointment there. And in terms of the why, you laid it out nicely. It's the Asia-Pacific region that was particularly weak. Of course, the company pointing to that slower than expected recovery in China. And in fact, CEO Brendan Foley, he said that the quarterly results were largely in line with expectations if you look across regions, but APAC specifically, sales for the consumer segment in the third quarter declined 16% from last year. You can see that disappointment in the shares, currently off by about 6%, trading at their lowest level since April 2020, John.
Katie, thanks for that. The latest with McCormick. The latest with the bond market looks like this. You need to go all the way back to 2007 to see yields this high. The 10-year high this morning, the cycle high, yields look like this, 474.74. The bond route deepening, strategists are odds about whether elevated rates could spark further declines in the equity market. Morgan Stanley's Michael Wilson saying this, stocks have experienced a distinct change in personality and investors are beginning to question the higher for longer narrative. On the other side, B of A, Savita Subramaniam writing this in the last 24 hours, equities can still work in a higher rate environment. The S&P 500 returned 15% every year from 85 to 2005 when real rates were 3.5%. Let's continue the conversation with Cameron Dawson of New Edge Wealth. Cameron, good morning to you. Always great to catch up. Do you think we can live with real rates this high?
It depends on how long they stay high. If real rates stay high for an extended period of time, then this period that we've been in where a lot of corporations and consumers have been able to delay refinancing debt as they termed out debt through the last cycle, that if we're not at high rates for a very long time, maybe they don't pinch. But the higher that rates stay, the more we will start to see it actually filter into the real economy, meaning that refinancings will really start to bite. We'll actually see interest costs pick up, even for larger names. Right now, we're only really seeing it in the small caps because they have more floating rate debt. It's one of the reasons why small caps have underperformed so much this year. So it really is a matter of duration, not just the level of where rates are.
Are you seeing signs that tech is stabilizing in the face of all of this?
Yeah, it's been really interesting. Last week, even as yields were surging higher, you saw tech start to recover some of its underperformance that it had really since the middle of July. And yesterday was mostly startling just because we saw such a huge move higher in yields, and yet tech was up on the day. Now, it's a good question of how much can that continue. Tech valuations are very extended. Looking this morning, the last time we were at real rates this high, the Russell 1000 growth was trading at 15 times forward earnings. Today, it is 25 times forward earnings. Now, interest rates aren't the only thing that matters for valuations. It's sentiment, positioning, growth expectations. But at a certain point, you cannot ignore the interest rates when you're thinking about valuing companies.
Do you need rates to fall or just stop going up?
That's a really good question because it really raises the question of why rates would fall, meaning that if rates are falling because you're going into a weaker economic environment, then it really isn't a good thing for risk assets overall, meaning equities and credit. Usually what we've seen is that in the first cut of the Fed, from the Fed, that you actually see underperformance from risk assets because the Fed is cutting for a good reason. So if we start to see rates fall because we're starting to see weaker economic growth and you're getting that flight to safety bid, it likely means that our earnings estimates for 2024 at $245 a share, up 12%, are too high. So it likely would have to be in context because if rates are falling for the wrong reason, not great for equities.
So this makes the next question really difficult, whether higher or lower yields would help the banks at the moment. Cameron, at the moment yields are higher, 10-year up by a couple of basis points, 30-year up by 4 basis points. Financials are lower again on the session. What do these banks need to see to start working again?
Oh, goodness. Well, we are in this sort of suspension of disbelief right now with the banks because they do have the benefit of that BTFP, the Bank Term Funding Program, where even though you have seen this big kick up higher in yields, banks haven't used it more, that program from the Fed. But if we continue to see bank stress, meaning the losses on the balance sheet because of these higher yields, it does raise the question if the Fed is going to have to extend that program. It expires on March 11th of next year, and that could reveal much more balance sheet weakness for these banks. I think there's this hope that yields would fall and they won't have to use that funding program for longer, but I think that's where the risk is as we think of the banks going into the next few months.
The bank earnings in a couple of weeks' time, 2 Fridays away for JP Morgan, Bank of America just around the corner too, the week after that. Cameron, what would you look for from Bank of America executives, JP Morgan executives when we get those earnings reports?
All about charge-offs, watching that really closely, because we've heard from some of the banks like JP Morgan warnings about the consumer, warnings about some corporations having more credit issues, and are they starting to include those charge-offs into their forecast, expecting that there's going to be more economic weakness. So if we start to see those kick up, that could be a sign that what the banks have been warning about could actually be very real, meaning that this period of economic strength we've been in, it will start to deteriorate. So I think that will be the key message in the next couple of weeks.
Both those names down this morning. We're down by about 0.8% on JP Morgan. Bank of America lower by about 1.6. Cameron, the bank executives, when I listen to Bank of America specifically, they were basically saying we don't see a recession. You listen to the airlines, domestic focused airlines, they're saying we're seeing weaker, softer activity. Are you seeing clear trends or conflicting data?
A lot of conflicting data. One of the interesting stats we heard this morning is that 80% of consumers have less cash in their bank accounts than prior to the pandemic. So a lot of these average statistics about cash balances and savings balances are really skewed by upper income households, and we are starting to see more deterioration at the lower end consumer. That's likely what's behind a lot of these auto lending companies going bankrupt, meaning that the people that are more likely to have loans from these companies are starting to default on them. So there are certainly signs that they're spraying at the edges. And the thing that is keeping this from becoming much more broad is the resilience within the labor market, meaning that as unemployment stays low, consumers are still able to spend and survive. If you start to see an uptick in unemployment, that would be the key thing that the consumer could tip over. We do think that the most interesting thing coming out of the ISM survey yesterday was talking about hiring freezes and hearing a lot more anecdotal evidence of companies delaying hiring until next year. If that happens, I think we have to watch really closely for the upcoming non-farm payrolls, because that could be the source of downside surprise.
Tons of labour market data this week. Cameron, thanks for the update from you and the team over at New Edge. Cameron Dawson there, looking ahead to payrolls on Friday. A little bit later this morning, about 17, 18 minutes away, we get JOLTS data, job openings. We get the ADP report, jobless claims coming on Thursday morning. We're pulling back just a touch this morning. About 13 minutes into the session, we're down by 0.5%. On the Nasdaq, we're down by about 0.7. Yields have been higher through most of this morning. We're pulling back from the highs of the session, though. High of the session on a 10-year, 470, 474, currently just north of 470. Yields up by a couple of basis points off the back of those moves. Bit of dollar strength out there against the yen. 150 is like the line in the sand at the moment. 149.98 is the high of the session. Almost there. Right now about 149.89. Coming up on this program, Sam Bankman-Fried heading to trial.
Clearly, I made a lot of mistakes or things I would give anything to be able to do over again. I didn't ever try to commit fraud on anyone.
That conversation up next.
Clearly, I made a lot of mistakes or things I would give anything to be able to do over again. I didn't ever try to commit fraud on anyone. I was excited about the prospects of FTX a month ago. I saw it as a thriving, growing business. I was shocked by what happened this month. And, reconstructing it, where there are things I wish I had done differently.
Former FTX CEO Sam Bankman-Fried speaking back in November after the implosion of his cryptocurrency empire. The trial kicking off today with jury selection in federal court. He faces a maximum prison term of 20 years for each of the 5 most serious charges, including security fraud, money laundering. He has pleaded not guilty to all of those charges. Let's bring in Bloomberg's Kaylee Lyons from outside federal court. Hey, Kaylee.
Yeah, John, you're absolutely right. Bankman-Fried is facing 7 charges in total, and if convicted and given the maximum sentence, he could very well spend the rest of his life in prison. He could be looking at a sentence of well over 100 years, and really it is his fate that is going to be decided throughout the course of this trial that could last up to 6 weeks. As you said, it begins with jury selection today, and then we will get into the argument phase. Prosecutors, of course, allege that Bankman-Fried orchestrated one of the largest financial frauds in U.S. history. They will say that he improperly commingled funds between FTX, which was the exchange he ran, and Alameda Research, which is the trading firm he also had founded and had insisted was operating separately. They will argue that customer funds were commingled and improperly used to fund risky investments, real estate purchases, and of course also the orchestration of this scheme enabled Sam Bankman-Fried to do things like make tens of millions of dollars in political donations. The prosecution also will be assisted by the accounts of multiple key witnesses, some of Bankman-Fried's closest associates at the time all of this went down. Gary Wong, who co-founded FTX with him, Nishad Singh, who used to be FTX's head of engineering, and Caroline Ellison, who was the CEO of Alameda Research, the aforementioned trading firm, and also his ex-girlfriend. All of them have already pleaded guilty to federal charges and are cooperating with prosecutors, so they will be able to lean on their testimony. On the defense side, though, Sam Bankman-Fried, already leading up to this trial, has said repeatedly it was never his intention to commit fraud. An intention is what is going to have to be proven over the course of this trial. And as you said, John, he has pleaded not guilty to all of these charges.
Katie, thank you. Thank you for the update. Looking forward to your coverage through today. From one legal battle to another, the Microsoft CEO Satya Nadella taking a stand in Google's antitrust trial, leaving no doubt about his perception of the search engine's dominance, saying, quote, "You get up in the morning, you brush your teeth, and you search on Google." Nadella also delivering a warning, saying Google is likely to extend its dominance of the search market into a new generation of AI-powered tools. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, I think we've got to sit on this just for a moment. Can you imagine 20 years ago, Microsoft testifying against someone else about having a monopoly? Just how big is this?
This is huge, given, the CEO of Microsoft is coming and, testifying at this trial. And look, this is a recognition that Microsoft, despite their early partnership with OpenAI and integration of ChatGPT, finds the distribution and data advantage of Google hard to beat. And that's where, the YouTube, the Maps, the Apple distribution that Google has, it gives them a huge leg. And I think that's what Satya is referring to, that because they have that distribution on Apple, they have the feedback mechanism to improve their AI, which Microsoft doesn't have.
What did it say about Bing that the CEO of Microsoft is saying that you get up in the morning, you brush your teeth, and you search on Google?
I mean, look, brand is a big advantage, and habits are hard to change, and especially with internet. Once, you have a platform which everyone is used to, until unless, obviously, ChatGPT solved for all the use cases that Google had, and that's the problem I think that ChatGPT is having, is they don't have the real-time information that Google has. So it solves for a subset of use cases. It's great for summaries, but those are just a subset of the queries that people do on Google, and Google still has the brand.
Mandeep, how much of a game changer would it be if Apple went in its own way, its own direction?
I think that would be huge. If there's one risk for Google's kind of dominance in search, or what they could do over the next 5-10 years, it's Apple developing their own search. Because look, they have the distribution. In the business of search, distribution matters. That's what Meta is doing. In fact, they launch character-specific chatbots, and what they're doing is the large language model could allow them to do search. That's what Amazon did, integrated search in their ecosystem. So if Apple started to do the same, that would would hurt Google.
They have the distribution. Mandeep, how difficult is it to build the business, the product, the service?
Well, so there are different elements to search. I alluded to the crawling aspect. Yes, you need the Gen AI aspect, but at the end of the day, you need to strike those deals with publishers. I mean, a lot of the publishers optimize for search engine, and that's how, you know, all these deals are done. So there are a lot of kind of nuances when it comes to building a search advertising business, but Apple definitely has the balance sheet to do that.
Mandeep, thank you, sir. Mandeep Singh there of Bloomberg Intelligence on this tension between Microsoft, Google, and where on earth Apple fits in the future. 22 minutes in, we're off the lows, pulling back just a touch by 0.2% on the S&P, on the Nasdaq down by, let's call it 0.3. With a sector price action, here's Abby.
Interesting sector composition once again, John, because despite the fact that we have that very small decline, most sectors for the S&P 500 are lower, led by consumer discretionary down about 1%, utilities down about 0.7%, healthcare, financials, and of course, something that many of these sectors have in common, yield. We'll be getting to that in a moment. To the top, though, industrials, staples, and technology down ever so slightly, sort of flipping around. As for the last several days, John, it's really interesting because everybody thinks about technology with yields rising, and that's where the real pain is. Well, take a look at the utilities. Over the last 5 days, actually since September 15th, down about 14%. This as yields have simply shot higher. The 10-year yield over the last 5 days up as much as 25 bips. Those dividends are less attractive.
Abby, thanks for that. Coming up on the program, your trading diary, a look ahead to the calendar full of economic data for the week ahead. 25 minutes into the session, pulling back just a touch. We're down here on the S&P 500 by 0.2%, getting a little better as things progress and the session grows older. That's the price action. Here's the trading diary. Coming up, what you need to be watching for: jobs data, job openings at the top of the hour, ADP private payrolls and US PMI data Wednesday. Thursday, another round of jobless claims and more Fed speak. Mess the Barkin Daily Bar. Friday, the September payrolls report. The estimate right now on my screen, about 170,000, down from 187. From New York, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
from the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, October 3rd. Here are the top market stories that we're following for you at this hour. The world according to Dalio. We bring you an exclusive interview with Ray Dalio, founder of Bridgewater Associates, live from the Greenwich Economic Forum. An SBF's day in court. Jury selection begins in Lower Manhattan today for Sam Bankman-Fried's trial. The government labeling FTX one of the biggest financial crimes in U.S. history. And yields keep climbing, and, so what? Yields hit new cycle highs pretty much every day. We see if stocks are at all paying attention. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Will we get any direction, Guy, from the JOLTS data?
Well, the direction is higher yields, certainly at the front end. They had moved a little lower. They are now definitely spiking higher. The reason for this, the headline number comes through at 9.61 million. We were expecting something to start with an 8.81. So that is a re-acceleration of the headline JOLTS figure, Alex, and the 2-year accelerates to the upside, the yield to the upside on the back of this data. That's the headline number. Let's break it down in more detail. Mike McKee is here to do exactly that. Mike.
You're right, Guy. This was not what the markets were expecting, and probably not what the Fed was expecting or wanted to see. As you noted, we've gone up in terms of job openings by 690,000 to over 9 million again. That is a significant increase for the JOLTS report, job openings and labor turnover. Hirings, the number of people getting hired, changed little. It's still at about 5.9 million, so a very stable situation there. And then the quit rate, everybody's been focused on the quit rate, doesn't change at all. Quits 3.6 million, pretty much the same as the prior month, and that leaves the quit rate unchanged at 2.3%. So it looks like at this point, employers are still looking for employees, and the labor market doesn't seem to be getting any looser.
As Guy pointed out, you have a sell-off in the curve, and also the yen weakens to 150 per dollar for the first time since October of 2022. And side note, the 10-year over in Canada is up 22 basis points. Might be a Canada thing, but nonetheless, we are seeing some chunky moves. Mike, thanks a lot. Really appreciate it. We want to take you now to Greenwich Economic Forum that kicked off today. Bloomberg's Wall Street Week anchor David Weston is now in a conversation with Ray Dalio, Bridgewater Associates founder and CIO mentor.
So if you look at everything that is happening, it falls into one of those 5 categories. Whatever we'll talk about and whatever others will talk about will fall into those categories. And then it's the interactions of those categories that creates the dynamic. So for example, if you have a debt situation that's problematic, and you have the sort of irreconcilable gaps that exist between, let's say, the left and the right, who doesn't follow things, may not follow the rules, you have a dynamic that is a lot of tension that produces those conflicts. So that's why those 5. So I want to keep that in mind. There are those 5, there's the interactions between those, and that's what we're going to talk about.
And it's very helpful, and it also accounts for almost everything in the news, everything we covered, with the possible exception of Taylor Swift. I'm not sure you covered Taylor Swift in there. But let's start with the first one there, the debt, and particularly sovereign debt and borrowing, sovereign debt. Right now, today, one of the big issues in the news is the yield on the 10-year. We're up at 4.7, something we haven't seen since 2007 or so, because of, in part, I suspect, a lot of borrowing and more to come from the federal government. So where are we in the cycle right now? Where are we? Where does the 10-year yield want to be, given where we are?
Okay. There are a few things that determine where the 10-year yield is going to be. The first is the basic inflation rate. Then there's the real interest rate on top of the inflation rate. Because the challenge, and I'm just dealing with mechanics here, I'm trying to explain the mechanics. You have to have an interest rate that is high enough that it is good for the lender, for the creditor, but not so high that it is detrimental or unacceptably detrimental for the debtor. So you see the real interest rate move around. Okay, when you have the real interest rate very low, like we had when nominal interest rates, nominal bond yield was less than 1%, and real bond yields were 1.5, 1.75 negative, that's free money. And what that free money does is everybody goes in and they borrow and buy things, and you create a tilt that's unhealthy. So what you've seen now is a shift. So let's put that in perspective. Well, before I put it in perspective, I want to get to the other factor that I mentioned. Related to that is the supply and the demand for bonds. In other words, we have to sell a certain amount of government bonds, and then there are buyers of those bonds. And the buyers of those bonds look at how attractive they have been. So let's look at that picture now. So if you take, let's say, the inflation rate, and what do you think is a sustainable inflation rate, which is somewhat debatable? I think that something in the vicinity of a 3.5% inflation rate, could be higher than that, not much chance of much lower than that. Let's use that as an example.
So that's not 2%.
That's not 2%.
But that suggests the Fed is not going to
for a variety of reasons we can get into why that dynamic has to do. Partially, it's because of the supply-demand issue anyway, so we'll get into that in a second. But you take, let's say that 3.5%, but there's always wiggle room. Maybe it's 3%. It doesn't look like 2% to me without a lot of pain. I mean, that's also why the Fed is having its interest rates where it is. Like when you get in the neighborhood of 2%, we can talk about 2%, but it's okay. But let's take that 3.5, okay? Now you have to have, in my opinion, something like, in a normal policy, a 1.5% real rate, okay? So now that gets you up to a 5-ish number, okay, for the bond. That is maybe something like equilibrium if you have a normal supply-demand situation. We have an abnormal amount of supply-demand situation in that the quantity of debt that we have to sell, the government has to sell, is a lot. It remains a lot. And the buyers are less inclined to buy the debt for a variety of reasons. First of all the buyers of bonds have gotten whacked. Okay, so if you look around the world, who are those buyers of bonds? How much bonds did they have, and how whacked did they get? They are banks. That's what the issue of the bank. They are central banks. Central banks have lost a lot of money, so there's a certain dynamic there that maybe I should explain. Well, what happens is when you lose money and you have a negative net worth in the central bank, do you capitalize the central bank or do you not capitalize the central bank, which is a conversation. But there's that. And then there are a lot of foreign buyers. The Japanese and so on have bought a lot. And so that there is lots of losses. And then there are concerns, deep concerns about the finances that we're looking at. And then beyond that, also this geopolitical war has caused some of the countries that bought that to buy the bonds and the big holders of the bonds to feel that they might get sanctioned by holding those bonds. So we sit at a moment in those bonds that it would seem that something like a 5% rate, and there's nothing precise about that, but in that neighborhood, would be maybe about right.
Well, it sounds like the risk is the upside of the 5%.
With the risk higher. Right. Okay? With the risk higher, meaning because this supply-demand picture, we have to watch this closely. When I put together the supply, which we know, and then you take the demand, I find an imbalance. And with that imbalance, then you're talking about other numbers. And the nature of the problem is also sort of a self-reinforcing problem, because when you have losses, how do you deal with the losses? Right now, the world is overlong. Portfolios are overlong. Sovereign wealth funds, reserves, and so on are overlong. Bonds, generally, there's a lot of them. That's somebody's asset. And at the same time, the U.S. bonds are a larger percentage of everybody's portfolio because the dollar is the world's reserve currency. So when you choose to save in dollars, when we say a reserve currency, that means you own that debt. And when you're owning so much debt, that creates also a supply-demand vulnerability. I'm sorry for the long-winded explanation of the mechanics, but my goal is to sort of pass along the calculations and the mechanics so other people can think about it that way rather than me just say that I think the bond yield's going to be.
I remember once at a Berkshire Hathaway meeting I went to in Omaha, Warren Buffett was asked, if you need to know one thing 10 years from now, what would you want to know? He said, the yield on the 10-year.
That's right.
That's the one thing I want to know. So it's something we need to understand. But what does that mean for the growth in the economy? Let's assume your assumptions are all right, that we are there. What does that mean? Can we have high rates and still have high growth?
Yes. I'm going to answer that, and I'm going to also throw in then, when you're looking at other asset classes, the reason Warren said that is because that becomes the return, that is the risk-free return from which the expected returns of other asset classes are compared. And so when we look at equities, what we say is, what's the expected return of equity? So we look at its yield, okay, just to cut through it quickly. It has about a 5%, 5 or 6% expected return. And because of that, that bond yield is a challenge for the equity markets, right? Okay, so then we've covered that, and then we can get into credit spreads and other things, but that's why the 10-year is important. What was your question again?
My question is, what does this mean for growth, economic growth?
For growth, okay.
Another way to put it is, are we about to break it? Are we about to break the economy?
What's happened is that the government got into debt, so the private sector would be relieved of debt. And that's the essence of what's going on. So, in other words, what they did in COVID and beyond is to send out a lot more checks than there were losses in income from businesses and so on to have a lot more money. And as a result of that, the private sector is doing a lot better, and the government sector is the problem in terms of taking that on, in terms of balancing that. That's just the mechanics of what's going on. What happens is, as you raise the interest rate, then of course you have to ration credit. Okay, either one way or another if interest rates go up, and that rationing of credit means that it slows the demand. So we're having this slowdown happening in a relatively orderly way because, let's take the household sector. The household sector's balance sheet has been improved much better than it was before. And then incomes with low unemployment rate and relatively high compensation increase have done very well. Plus there was this inventory of money that was large, and it is going down. So what we see is a natural slowing, that there should be a significant slowing in the demand as that interest rate then passes through, and that's what we see. That's what we see in the economy.
It's a natural slowing, but it was given more than a little shove by the Fed. I mean, they raised the interest rates quite a bit. Is it a false choice between, on the one hand, curtailing inflation and getting robust growth? Because it looks right now that the Fed is consciously saying we need to slow things down to deal with inflation, but it really is going to hurt growth.
Well, it also is this supply-demand government debt problem. Yeah. Okay, let's be clear that we have a government debt problem. We have a major government debt problem. So if you just continue adding and the debt continues to rise, what happens in this classic cycle is that the debt service squeezes out consumption more and more. We can see that beginning to happen in the government because the debt service, as it rises, then starts to squeeze out other areas, and there are not many discretionary areas, so you extrapolate that. And then there's the big issue that could exist, and there's a big risk of it, which says there's a selling. If we have the selling of those bonds, then the whole supply, it's not the new amount that matters, it's the whole amount that matters.
So given all of that analysis and understanding we now have, how do we make some money? You're an investor. So where do you put your money in that world?
Well, I want to say, I'm going to answer in two ways. I'm going to say that first, there's a saying in the markets, he who lives by crystal ball is destined to eat ground glass. Okay. What I mean is, what you don't know is very important relative to what you do know. And for that reason, understanding how to properly balance and diversify a portfolio, and that diversification should be countries, currencies, and asset classes, is something that's important. For most investors, to make tactical decisions is not going to be the best thing they can do. They'll do that badly. And when you come to conferences like this, you will get different points of view. Right. But unless you actually have a system and you mechanize, and we put hundreds of millions of dollars, lots of money, maybe $1 billion, I don't know, into doing it technology and so what to try to get an edge. So, number one is respect what you don't know and know how to diversify well. Because diversifying allows you to reduce your risk by up to 80% without reducing your income, without you reducing expected return, if you know how to do that well. Okay. Then I think then what you have to do is you have to look at the relative appeal of asset classes. So when I go through that calculation, the relative cash now has a relatively attractive appeal. Sort of people, when I said cash is trash, and that got a lot of attention. But that's when cash was nil. Okay. Now, when you look at the expected returns for this moment, cash is a relatively attractive asset class at this moment. It's not just attractive because it has a relatively decent, not great, but decent expected. In other words, it has something like a 1.5% real return, okay, not bad, and not bad in comparison to the other things, and it doesn't have price risk. So it looks relatively attractive, but let me complete the answer before you, because I see you're pulling at the bit. But then also, I think in this environment, and given the whole picture of all the things at work, there are three things that I look at as to where to invest. I want sound finances. So I look at income statements and balance sheets of countries. I want to invest in countries where they earn more than they spend, and they have more assets than liabilities. Okay. Second, I don't want to have where there's a lot of internal conflict, because the internal conflict is very dangerous. We haven't gotten to the political. We're still in the bond market.
It's coming.
Okay. But when we take a look at that element, that's a dangerous element, okay? And number three, I don't want to be in a place where there's going to be an international war. Because that's detrimental. In history, when there were these types of conflicts, the neutral places actually did better than the winners in the conflict.
What I was going to ask about is price risk, and particularly with respect to bonds, because right now you can get some bonds, even for some investment grade bonds and otherwise, that have a pretty high rate on them. But instead of that, you'd rather be in cash, and is that because of price risk? Because you think what the future holds?
Well, I think what you think is a high rate is only biased by the terrible rate that you got used to. Okay? So if you take, let's say, the real rate right now, you're looking at now close to a 2%, roughly about a 2%, which isn't bad, but it isn't, in a historical sense, it isn't great either. Great is like 4%. But it's not bad, and so I just want to be clear. And then you have the price risk.
So let me ask you about equities. From everything you said, it doesn't sound like risk assets are really attractive. But let me draw from your fifth force, and that is innovation, creativity, AI. Is there an exception right now in the marginal allocation of equities when it comes to big tech for AI?
Yeah, this, in my opinion, is going to be a super huge impact. Generative AI and so on. I won't get into all the reasons why, but I think it's going to be an impact. Then there are those who are doing it, and then there are those who are going to use it. I think a lot of those who are doing it and inventing are in a bubble. I mean, they're very expensive, and they themselves will be disrupted by others. It's the nature of that beast. So it's very, very difficult at these prices and so on to do that. Those companies that are really knowing how to use it and to gain competitive advantage will do well.
Generative AI overall for the economy, is there a chance of letting it help us grow out of the government debt problem you had?
Yeah.
Because if we really increase productivity substantially, that must help us on the government debt.
Certainly. It can have an enormously beneficial productivity impact. For example, but it has a big impact. So, for example, combining AI and robotics, which is a new thing, is essentially making people. And okay, so those people don't have to work. But then you still have to deal with, okay, what does that mean? We have a situation, a basic dynamic here, in which some people benefit hugely, and then some people, it's absolutely terrible for them. And it's not just the middle class. So, give you an idea, there are 3,100 counties in the United States. Counties is the smallest economic unit, a county. 85% of those counties voted for Republicans and want to go back to, in a sense, more conservative roots. And then you have, you could see how the red and blue lights up. And so the issue is, as we're dealing with this, if we have the good outcome of it, how are we going to do with it? We need a real restructuring. So I think on the politics one, I just want to say the following. We are at risk of a civil war of sorts, right? We are at risk of a civil. In other words, what I mean is that there are irreconcilable differences, not only in the issue of wealth, but the issue of values, okay? Gender issues and so on and so forth. Okay, irreconcilable. And there's a questioning of whether the system is fair and will work well. When you, in any game, any sport, when you don't trust the rules or don't follow the referees, it's a very dangerous situation. And so that particular conflict, as we deal with this, there's only, in my opinion, there's only one way politically to do that, and that is that you have to have a very strong middle, okay, a political middle, in a sense, a bipartisan middle, that brings the center, mostly, which still constitutes the majority of the population, brings it together, and then is going to have to make major reforms. Reforms, you're touching on some things like, okay, what do you do should you have the benefit of that productivity miracle? How do you change who benefits? The system as it now works is those who come up with the idea, they become multi-billionaires and the others lose jobs. Okay, so how are you going to actually deal with that? I'm not saying that. I mean, I would say, I would know that if I was president or who should be president, and I'm not talking about me being president, but I'm saying if there was president, I think they should have a bipartisan cabinet. You need a center. You have to have bipartisan. And then they should have something like another constitutional convention, in a sense of those, to deal with reforms. And there are lots of reforms that need to be made in order to deal with questions like that. And of course, there's the both sides of that. And many will tell you, there are, the productivity maybe can do it, but then there's also the risks of it, which exist in many ways, like particularly for having war with each other and such things. These 5 factors are going to be changing at a very, very fast rate. I think over the next 5 years, you're going to see very rapid changes in all those, and it'll be almost like going through a time warp. And when you get to the other side, I mean, think about the political questions that we're dealing with right now, the debt issues that we're dealing with right now, the Chinese-U.S. relations, and the technological impact. These over the next 5 years are going to be dramatic.
You took us right to it, China, because we haven't dealt with external conflict. We're talking about internal conflict, not external. You've been going to China, I think, since 1984, something like that. You know China terribly well. Give us your assessment of where we are with China, U.S.-China relations, and where China itself is right now.
Okay. U.S.-China relations are in a number of areas on the brink of red lines. So, in other words, these irreconcilable differences, they're right on the brink. So if I was to take, let's say, the Taiwan issue, it's an irreconcilable issue, and so on. It's right at the line. The breaking point is if the United States said, we are in favor of the independence of Taiwan, that's the equivalent of a declaration of war. And because of our political issues that are now internally, you're going to be likely to push that because of the fact that many in Congress and so on would say we will defend Taiwan at all costs and we will give them this, and you could even cross that line. My point is it's right at the edge. That's that. We have a chips issue, and we have a technology and sanctions issue. The reason in World War II, war with Japan, you had the cutting off of the oil and then the sanctioning them taking their payments. So you have a somewhat similar situation. Chips is like oil back then, and it's a very, very, very delicate issue. You have the geopolitical issue, which also is manifest in each of them and so on supporting Ukraine, and other geopolitical issues which are also right at the edge. Neither country wants to go to war. Everybody's afraid of what that war would be like because it would be devastating economically and politically. So you will see sort of the postponing. These issues will remain and probably intensify over the next 5 to 10 years, but they will be at that edge. So you're going to see in November there will be in San Francisco the APAC conference, and you will see President Xi get together with President Biden. But we have a political situation and so on, that's it. In China, they are also dealing with a number of big problems. As we're dealing with our problems, they're dealing with their problems. Those problems are first the debt problem that has now been allowed to pass through into the system. Meaning you have real estate, and real estate counts for about 70% of savings, and people put their money in real estate, and about 20% of their economy. And there was a bubble, and then that's passing through, and that goes down to local governments that were living on debt and also land sales for real estate purchases. And so that's a structural issue. They need to do a debt restructuring. And a debt restructuring is a very difficult thing to do. They can do it, but it's also very politically impactful because those who are, whoever's making these decisions determines whose wealth and how they divide the pie. So you have that going on. You have a move to what President Xi calls the 100-year storm on the horizon. In other words, he believes there's a 100-year storm on the horizon. That's the sort of things that we're now talking about. And with that 100-year storm on the horizon, you have a very autocratic, in other words, if you don't behave well, you'll lose your head, and so on. And that kind of environment, which, by the way, in war periods and so on, has been what most countries have moved toward or something. And so that's having an effect on the economy. We have the U.S.-China conflict itself, which is affecting what companies do. Do I want to be in China or do I want to be in Vietnam? That's one of the things that's benefiting neutral countries. So they think, okay, if the ASEAN countries, India and other places can be a beneficiary of that. Where do I want to be? But that's also hurting them. And then, of course, that we have a world economy which is relatively slow moving. That affects their exports. So they're going through a very difficult period.
So let's try to end this on a high note. Middle East, of all places. Middle East. As I understand, you have an office now in Abu Dhabi.
Yeah.
There are a lot of reports about a possible deal, seems unimaginable, of Saudi Arabia, Israel, and the United States. Don't know if that's going to happen, but it looks like it might definitely be possible. If that happened, how could that transform, certainly that region, but maybe the global economy?
Well, there's a realization there that not fighting and prosperity is better than fighting depressions. So for very practical reasons, if you take MBS, MBZ in the UAE and so on, there's a desire to move in that direction, dealing with the geopolitical issues. Those geopolitical issues are to some extent within the region, having to do with Palestinian and so on, and to some extent worldwide, like in a conflict. So the movement, you saw a movement, Saudi Arabia and Iran. Whoa, that's a big deal. And now you're seeing that line up in that way with Israel. So as I say, there are three things that I'm looking for, right? Do you earn more than you spend? They do. Do you have an environment in which there's internal vitality and people working together and so on? A lot of changes have been made in these places to make that really, I mean, it's a vibrant place. These places are talent magnets. They're competing for talent and they're getting talent because of that environment. And are you in risk of one side or another of the war, or can you stay neutral? Because the neutral countries do better. So that's what they're benefiting on. Those countries are, they're doing very well. And there will be places in the world, India, ASEAN countries and so on, which will do very well while all this is going on.
Last question, Ray. What comes next for Ray Dalio? There was speculation about going back to Bridgewater, which you've denied.
That is
you
such
said it was not going to happen. But,
wrong.
But
by the way, don't trust the media.
I mean, I'll attest to that. I've been here for a long time.
Okay.
I'm with that. But are you interested in creating your own fund other than that?
No, I'm not creating my own fund. Okay. I have a family office that manages family and foundation funds. Okay, and I'm doing that. But what comes next? I'm at a phase in my life where it's very natural. I'm 74 years old, and the most important thing for me is to pass along everything. Okay, to pass along some of the knowledge and principles that I've learned over a period of time, which is why I'm doing this, why I'm writing the books and so on, and to pass along the wealth, and to pass along other things, and pass along Bridgewater. What a joy it's been to start it out of this two-bedroom apartment, and 47 years later, to build this extended family and these wonderful people who are very, very capable, you know them, and to have them, this next generation, flourish and be a bit of a mentor to them. What a joy that is. And so my objective is to do that. My son gave me a book by Joseph Campbell called Hero of a Thousand Faces. He says there's a life arc. And there's a part in your life journey when there are three phases in life. There's the first phase where you're learning and you're dependent on others. Kids, they go to school and so on. Second phase of one's life is you're working and others depend on you and you're trying to be successful. And then there's a transition to your third phase. And in that third transition, he described it, and I instinctually feel it. There's this, what he called the passing of the boon. Now, what is the boon? I didn't know what the boon was. The boon is what you've acquired, that are the gifts that you've acquired over that period of time. So I'm now in that phase, and I'm going to put out one more book, Economic and Investment Principles, and then I'm going to be done with that phase. And so that's where I am. I'm savoring life with, my family, the things I like to do, and that's where I am.
Well, thank you for sharing some of the boon with us today, Ray. Thank you so much. Great to be with you. It's Ray Dalio.
That was Ray Dalio, Bridgewater Associates founder, CIO, mentor, along with Bloomberg Wall Street Week anchor David Weston. We will have plenty of exclusive interviews from the Greenwich Economic Forum throughout the day, so stay with us for that. And while that was happening, Guy, a stunning stunning move. I feel like I'm channeling Tom Keene, but stunning move evolved in dollar yen. That was really triggered by the JOLTS data that came in much stronger than expected. We had a move up in the dollar and then a dramatic reversal as the yen gained some strength here.
Yeah, we've unwound certainly the last few days of price action that we've seen in dollar yen. We've all been waiting for, anticipating this move through 150. Looked like it was going to be a tough move to make given just the resistance we were seeing. But yeah, that move lower, I think a lot of people are scratching their heads trying to figure out what is happening here. I've certainly been, I've been emailing people while we've been listening to Ray. Everybody's a little bit confused. Is this options? Is this the BOJ hitting the phones and checking prices? Nobody's quite sure.
Yeah, or are they actually intervening? And it feels like one of those three things. Maybe there was a massive stop that was triggered at 150, and that's why you wound up seeing it. But I do want to point out, thanks to Dan Curtis for telling us this, it's the widest range on yen intraday since the policy tweak news came out back in late July that really roiled the market. So, I mean, this is a big move. It's hard to kind of understate this at this time. So let's get more into this. We're going to talk much more about this and what it winds up meaning. We're about an hour and change into the trading session. Again, dollar yen sort of surging above that 150 and then coming lower. Abigail's tracking some of those moves for us. Abigail?
And here is what it looks like, Alex. So into the JOLTS report, basically flatlining just below 150 for dollar yen, but then higher above 150, the highest level in a year on more job openings being available. And then this talk about the possibility of the BOJ intervening almost down to 147.13. At that point, the yen versus the dollar up about 2%. Coming off those levels a little bit, I'm going to be really interesting. I haven't had a chance to put this into a technical chart to see what it looks like relative to some of those levels. But something I would point out about that July intervention, the BOJ, if I recall, said that they would allow the 10-year JGB go up to 1%. Once it floated toward about 6%, they came in. So they have some work cut out for themselves in terms of credibility with traders. As far as the dollar yen over the last time period, to put this move into the context, if we go into the Bloomberg terminal, we can see what all of this looks like, and I'm going to be curious to see, and actually, we'll be taking a look at that in the future, but this is really a very dramatic move. As for stocks here in the U.S., last time I looked, well, now we're looking at a big decline on this. We have the S&P 500 down about 1%, the NASDAQ down 1.3%, the Russell 2000 down 1.3%, that Russell 2000 breaking down below its last low, well below its 200-day moving average. These growthier small cap companies perhaps leading the way for the S&P 500 and the NASDAQ 100 to do something in a similar fashion. And then finally, one other pressure on stocks today. It's not just this volatility, and here is actually another breakdown that we're seeing. The utility index down about 14% over the last about 15 trading days, 10 to 15 trading days. People don't really think of utilities as being sensitive to rates, but it's one of the most because of the rich dividends. When yields go higher, these dividends look less attractive. Well, over the last 2 months, there's that 2-year yield. Not a huge move, but at 5.13. The 10-year yield, though, up 56 basis points at a 4.73, seeming to follow that 2-year yield higher. And then just to start out where we started, end where we started, here's the Bloomberg Dollar Index higher, but here is that dollar yen, 148.90. It's just going to be so interesting, Guy, to watch this throughout the day. I cannot wait to take a look at the technical chart. Maybe I'll bring one back in the 11 o'clock hour.
We will look forward to that, Abigail. Thank you very much indeed. Yeah, definitely need one of those. The question of the day was related to yields and stocks and things like that. But to be honest, I think the question of the day now is, who did that to the yen? Was it just a simple kind of market positioning story? I say simple. Obviously, this is a complicated process. Or has the BOJ been picking up the phone and maybe asking a few people about prices, and that kind of freaks a few people out, and that kind of freak out wave gets bigger and bigger and bigger? Let's try and figure out the answer to this. This is McCormick and Simon White join us now to discuss. Simon, what do you make of the price action? You talked to us last week about the kind of the unstable ruler. It is inherently unstable. Everything feels very much on edge, and in some ways that yen move speaks to this.
Yeah, I mean, the market's kind of been pushing in that direction for some time. And if you look at the yield differential between, say, US 10-year yields and JGB 10-year yields, like, it's obviously very, very wide. And that's creating that pressure on the currency. And, it's very uncomfortable for Japan right now. I'm actually surprised they've held the line for so long, right? They have inflation's high. much higher than it's been for many, many years, and inflation expectations have been rising as well. So there's surely got to be some people, at least in the Bank of Japan, that are beginning to get at least a little bit concerned here.
Yep.
But they've held the line thus far, and the market's kind of been pushing them, I guess. You know, the dollar yen now up at 150, which just adds to inflationary pressures in the longer run as well.
Yeah.
So yeah, clearly it's a very unstable situation, and anything can happen in a situation like this.
Well, I think that that's such a key point. Anything can happen, Liz, and this was one of the things. Like if you put a list and all the things that's going to rock the bond market, this is number one on the list. Not in terms of changing the yield curve control policy, and this is sort of maybe the first step that goes into that. What do you think?
Yeah, Alex, it seems like all those maybe problems keep seeming to pan out. I mean, the Bank of Japan didn't change the policy yet, but that pressure is building, right? We have all the supply we've talked about. We have the economy continue to be strong. Saw the JOLTS data today, right? And somebody said, what happened to the job market rolling over? Not happening, right? So there just seems to be a lot of factors that are just keeping the momentum going with the rise, especially in long-term rates, have just taken off.
Liz, how would you describe this market? How jittery is this market? How uncertain is this market right now? We've been through a period in some ways where the market was quantifiable. It feels very unquantifiable at the moment.
Yeah, I think that just hits the nail on the head, Guy, that it's like nobody, I mean, we're coming up to, I keep saying that, but it's 3 more months, but it could be like 3 years of annual losses for the Treasury market. That in modern times has never happened, right? So all those bond bulls, they're, slowly losing their stomach, right? We see some, covering as the rates keep going higher. And I think it's hard to have conviction because I was talking to a colleague, super smart, saying, is the Fed done? And who can say the Fed's done or not? Definitely they're close, but even the Fed can't say they're done, right? They just need to see the data. Friday we have the payrolls report to see if there's any signs more of that rolling over. We didn't get it in JOLTS. So I just think the market is too nervous. It's, you do see some buyers peppering in, but it's kind of hard to catch a falling knife here, right? Really go vigorously long.
We'll talk about falling knife, and I mentioned this at the top of the show. Canadian 10-year bond yields are up 22%. On basically just a central banker saying, hey, maybe price increases will continue for companies. But that kind of move off of that kind of sentence seemed very dramatic. Simon, that seems to me we're going to see increased vol when it comes to rates. I'm wondering now if it's increased vol when it comes to FX. Not seeing it yet, though, in the equity market.
Yeah, vol does ultimately tend to move together, but the VIX is the one, as you say, it's been like the outlier. But the setup there, again, it's a very unstable situation. It just takes one catalyst and all of a sudden you can end up with a lot higher volatility. A lot of volatility in the US equity market has been repressed by essentially option speculation, so the gamma hedging of option dealers. But gamma is now negative or very close to zero, which basically means that the market is inherently unstable. It doesn't really take much to unseat it. So something coming out of the, slightly unexpected, something like dollar yen going through 150 and then bouncing back down again. It could be anything, could come from any direction, and you all of a sudden have this catalyst are already there.
Within the stock market, though, individual stocks are kind of moving around like kind of little molecules in a balloon, and they're kind of bouncing off each other, but there's no kind of sense of direction because they're not all moving in one direction. What would it take to get stocks moving in one direction, and that therefore to give us an index sort of sense of direction, a clear defined index sense of direction? Because at the moment we're kind of bouncing around all over the place with single stocks. The yen move, is that big enough? How big a catalyst is required, do you think?
You're exactly right. One of the reasons why vol has been so low is implied correlations has been low, right? But a very narrow-driven market, the AI-driven rally, and most of the other stuff is just kind of a wash.
Yep.
Right? So you end up with VIX very low. So what would take it now? For instance, if you've got this very unstable market, so these option dealers, there's a huge number of puts options that they are short of. So people come along, they want to hedge. You're a retail investor, they buy puts. So these option dealers, they're on the other side. If the market starts to move through lower, all of a sudden these option dealers have to hedge these puts. So that's the sort of thing that could suddenly drive all stocks moving together at the same time, and you get the sharp rise in volatility, and you get a big move through, and that move will continue until these guys are hedged again.
Yep.
Gamma hedging. Whenever you talk about gamma hedging, there you go. And I should point out, I meant 22 basis point move on the Canadian 10-year.
You knew what I meant. But still, that was a huge move. All right, guys, thanks a lot. Liz McCormick and Simon White. We really appreciate your time today helping digest some of these very dramatic moves. Dollar yen now at 148.99. All right, coming up, you also have House Speaker Kevin McCarthy. His job is on a knife's edge. He tries to stave off a Republican revolt. We're going to go through some of the details next. This is Bloomberg.
It seems very personal with Matt. It doesn't look like he's looking out for the country or the institution. If you throw a speaker out that has 99% of their conference, that kept government open, and paid the troops, I think we're in a really bad place for how we're going to run Congress.
That was House Speaker Kevin McCarthy speaking earlier this hour as Florida Republican Matt Gaetz moves to remove the Speaker from his position. We want to go to D.C. Bloomberg's Washington correspondent Emery Hordern joins us now. All right, Emery, does McCarthy have the votes?
Well, he's going to put it on the floor, and we'll soon find out. It's just the math is very difficult for him because the Republicans hold, even if he said, like he said, just briefing reporters, that he has 99% of his conference. The fact of the matter is they hold such a slim majority. So only other 4 members would need to join in with Congressman Matt Gaetz of Florida to oust the Speaker if the Democrats also agree to oust Speaker McCarthy. So it's really almost in the Democratic hands control. Hakeem Jeffries spoke about this earlier today on MSNBC. He said he really does feel like this is in many ways a vote of conscience. He wanted to hear from every member of his party today. These caucuses met behind closed doors, and he said that at that point we would then make a decision on how we would be voting. So depending on if some Democrats decide to not show up or vote present, Speaker McCarthy would be able to maintain that gavel because the margins would be much easier for him to clear. But make no bones about this. This is going to be very difficult for him, and potentially he will lose his job.
Anne-Marie, would the Democrats want anything in return for keeping Kevin McCarthy in the seat? If so, what?
They did, but Speaker McCarthy said that is off the table. And when he briefed reporters and they were asking about this, he said, look, we have the majority. Why would we surrender it? I'm not willing to do deals with the Democratic Party to maintain this job. What we do know from our colleagues reporting up on the Hill was that Democrats actually wanted maybe some more concessions or some more power within how rules are made or some more appointments on committees, almost what you would call power sharing in the House. And Speaker McCarthy ruled that out.
More political instability. Everybody's paying attention. The markets are certainly watching this story as well. It's just another factor to fold into what is happening with this yield story. Anne-Marie, great stuff. Thank you for the continuing coverage. Anne-Marie Hordern joining us from DC. Coming up today, we need to talk about the Wall Street beat. We're going to be talking about what's happening in this market as well, which is just kind of continuing along the routes of everything going private. Brookfield Asset Management raising $12 billion for its largest ever private equity fund. We're going to talk about that next. This is Bloomberg.
All right, time now for Wall Street Beat. We take a look at what's buzzing on Wall Street and the world of banking and finance around the world. We're taking a look at Brookfield here, raising $12 billion for a new private equity fund. Joining us now, Bloomberg's Sally Bakewell. Sally, take us behind the deal here.
Okay, so we have private equity facing really sort of the toughest industry since the financial crisis, with inflation, with rates, and these rich prices that sellers are demanding, keeping a lot of the titans on the sidelines. But yet here we have Brookfield coming out with its largest private equity fund ever. So it really shows that this company is able to rally sovereign wealth funds, pension funds, to invest in its deals, because even though they're becoming more selective in this difficult environment, companies like Brookfield are able to sort of attract that demand.
Sally, what kind of IRRs are funds like this going to be looking at? What are the vintages that we're currently in going to be looking like? Is the return story changing when they go out and pitch these funds? What do you think they're telling the LPs?
I think the industry has become a bit more disciplined. A lot of the investments in tech and health companies that were made over the past few years, they haven't transpired to turn out so well. And so that has helped bring valuations down a little bit for companies like Brookfield. They are seizing on this opportunity and seizing on some of the dislocation in the market with volatile markets to take sort of advantage of these more reasonable prices. And so, you know, some of its peers like Apollo, like EQT, it has far surpassed the tally that they have been able to acquire just through June.